Welcome to the Supporters Fund, Ask an Investor. I'm your host, Jeffery Potvin. Let's please welcome David Evans, the managing partner of Centiro Ventures, as our investor for today. Welcome, David. It's a real pleasure having you join us.
Well, Jeff, thanks for having me.
Well, we're very excited, David. I know we got to see each other at Collision. We've been chatting, I guess, on and off for a couple of years. So excited to kind of dive in. And the big reason is that you're also a tech investor, and I like tech. And being the fact that I'm an ex-software engineer, it's very rare that you get to have a deep talk about, well, deep tech and all this great stuff. So I think we're going to have a great discussion around that. But also, I think what really stands out, and hopefully you can share a little bit about yourself and, go far back is your Connecticut university days. But really, you have a great story. You started coding at 14 years old, built a couple of companies, sold them, so many great things in there. So maybe you can share a little bit about your background, where you're at today, and then one thing about you that we wouldn't know.
Yeah, sure. So, I think kind of I always describe it as I'm a technologist, entrepreneur, and investor in that order, right? And some of it is because I did start coding at 14 years old on a TI-85 graphing calculator. Wrote blackjack, and it went viral in my high school, right? And this is the days before you had the web to go viral. Like we had little sync cables to make it go viral. So started coding really, really young without a lot of direction. I had a natural propensity for it. That's why I say I'm a technologist first, right? Started my first business at 19, while actually at Johns Hopkins University. That's where I started my education, was at Johns Hopkins. But like all good techies, I dropped out early, right after my sophomore year. I left Johns Hopkins to go work in tech in the middle of the dot-com boom, and spent about 2.5 years working for a consulting firm, and then moved on to an actual dot-com that went out of business. So I had that little bit of a ride, and my first exposure essentially to startups, venture capital, and angel funding was through that startup, soldout.com. And when they went out of business, I actually launched my second business, Geode Software. That company still exists today. It's really just a custom software development company, mostly services based, but we develop products for companies as wide ranging as NASA to digital signage in every Albertsons across the United States. As part of that company, I actually got involved in the secondary ticketing space. So think companies like StubHub, Vivid Seats, and in 2005, I actually launched my own company in the space, Easy Seat. And Easy Seats launched it in 2005. By 2010, we were 176 on the Inc. 500. We were the 6th fastest growing retailer in the country. And it's not because I was a great retailer or a great seller of tickets. It was because we had great tech, right? We automated the distribution of digital tickets as early as 2008. We had predictive pricing models. We had automated pricing. We had even tools that could tell us if a concert would sell out within 48 hours of when it would actually sell out. So it was really about the tech and not us. Wasn't an industry I was passionate in, so I actually sold that business in 2015. And at that point, made the shift to the other side of the table into investing. First as an angel investor, working mostly as an angel, and then got involved with a fund here in Dallas, RevTech Ventures, that was focused on retail technology. Right, I'd been in the e-commerce space, so it was a natural fit to work with David at RevTech, and that was kind of my first opportunity to move from being an angel, where it was my money, to being a venture capitalist and investing other people's money. Which there's a dynamic there, and I'm happy to share it. But there's a different psychology when you become a steward of someone else's money versus your own. Took that experience with RevTech to launch Centiro at the start of the pandemic, which was not the best time to start. It was in January of 2020, but we did raise a fund. We're currently in active deployment. We've got nine companies in the portfolio. And expect to make a couple more before we go out and raise fund too. So I think that kind of covers the background. I think you said the one thing that people may not know. I realistically speaking, I always talk about this. I never intended to start any of my companies, right? So it wasn't like I had this grand vision of, hey, I'm going to go and build this. Geode, it was soldout.com went out of business, right? They flamed out and the .com bubble burst. So I had a choice to go work for somebody else or start my own business. And I'm sort of a dyed-in-the-wool entrepreneur. I went and started my own business, right? I'd rather make nothing and be building something than make six figures and have to answer to somebody else. Easy Seat was very similar. Part of the way I got into the industry was through a failed partnership with one of my clients at Geode Software. That actually got me into the ticketing business. And then even venture capital, right? Like it wasn't something that, it was something that just because of my experience, I got connected with RevTech and it really kind of pulled me across the aisle into venture capital. I really only had started making private investments because I like the start phase, right? I like the 0 to 1 of startups, which attracted me to angel investing. And now it's kind of pulled me over into venture capital.
Awesome. And a great story. And of course, sharing that you started this all at 14 and then kind of worked your way through the racket and learning. And I guess there was some fails through the companies you worked for, but you kind of built and learned what it took to be an entrepreneur. I guess the first question I'd have is that when you look at being an entrepreneur back when you were 19 versus today, what do you see the big significant differences are? Because like you said, you're like, I could take a 6-figure job or I could build it myself. Mm-hmm. Was it easier to build it yourself back when you were 19 and go get a 6-figure job inside of your own startup that long ago versus today where it seems to be a lot longer grind and build to get to a 6-figure salary? Or is that completely reversed? And I'm looking at this the wrong way. How do you kind of envision that?
I think a lot of it's based on deferred gratification, right? So personally, it's a lot easier now, right? I've got some pelts on the wall. I've been there. I've done that. Every mistake there is to be made. I usually tell founders, I've made that mistake at least 3 times, and there's a good chance I'll try to make it the 4th. But the difference between today and then is, I kind of know it going in, right? I know that, well, yeah, we probably shouldn't go build a bunch of tech right now. We should go do a little bit more market validation, or we should go do, I know better, but I may still do it anyway. And that is a massive difference, and that's a massive change. I think the other thing that evolves over time is I usually always talk about, like, I didn't really learn how to be a CEO until about, call it 2010 or 2011, right? Like I was very much, I was far more tactical. I was far more of an operator than a CEO and a true executive. And that's one of the big differences between then and now. That's on the personal side. From a market side, I think it's actually a lot easier now than it was then, right? Things like digital acquisition funnels make life so much easier to find customers, to find clients. Low code platforms make it so much easier to spin up prototypes and start to validate your idea before you ever actually get going. So I think it's easier to get started, but I think there's so much noise. Going from 0 to 1 is easier than it was 25 years ago. I think going from 1 and up has actually become more of a challenge because there's just more clutter to have to cut through when you do start to get some traction.
Yeah, I can totally agree with that because I do think that the startup phase, everybody's built enough tools to get you moving quickly. So that 0 to 1 really is quick. And then after that, it's really, how do I find my market? How do I get in, create a segment, find the customers and get them talking to me? You mentioned one thing inside of this, which is you'll probably still make the same mistake, which is go and build the tech. Is that because being a coder and doing this many times, it isn't really a mistake? It's more of you want something tangible to get in front of people to move quicker. So in your mind, you're actually moving quicker because you know how to code and you know how to move that dial faster than the average person would. So it's not really a risk or a problem you're doing. What it is that you're going to validate quicker. So someone that might take 6 months to build a system, you're building that in 2 and you're going to market. So you've already assumed the risk and said, I can do this quickly. Let's get it in, test it, and then start to build out where you fit in the market. Is that a fair assessment?
I would agree that, when you talk about kind of building to prove the market, that it's all about trying to find the right balance, right? Is how much do you actually go and build? When do you actually take the cover off and start to engage with customers? Humans don't have don't do very well at sort of envisioning how things look. You always stage your home if you're going to sell it, right? Because you need to give them a picture of how it's going to work. It's the same thing with tech, right? You kind of need to stage your product well enough so that people can understand how it fits. So I think the mistake is building a full product, right? The mistake is actually getting to the point of where you go and you spend, very early on. I spent 18 months building our very first product at Geode Software. At 18 months, our very first sales call, I knew we had a problem, right? Because it was just a wrong market timing. We can go into that later, but ultimately, 18 months of effort went down the drain that could have been addressed with that very first sales call, right? Having that very first call with a potential customer would have saved me 18 months worth of actual engineering time. So it's finding that balance, right?
So I guess in taking that, what you just shared, is it kind of more of, everybody always says build to this MVP, which completely means, something small and get it to market. And then there's a lot of others that will say, go out and learn from the customer, learn where you want to be, and then build the product and build it with them so it ties them in. So in the sales process, what you're trying to do is enable the people that you're working with to help them feel empowered by sharing that you're building something that's solving something that they know well. They spent 30 years in this space, and you're working with them to build this versus coming in new, building something for 18 months and then dropping it on their lap and saying, this is going to solve all your problems. I know you've been in this space for 30 years. We know better. So here you go. Is it kind of that work up and work into the space versus trying to be the solutionist every time and thinking, why doesn't this work?
Absolutely. And I think there's two distinctions there, right? One is, and at Sentiero, we like to look at founders that have experience in their industry, right? It may not be a lot, but it may be 1 or 2 years, or maybe even 10 years or 20 years of experience in the industry, to where you do have some of that understanding from the inside, right? At that point, and I think this goes back to your question to me earlier, is that, when I go and I build that product, I'm going and building it because it's a space that I have some knowledge about, right? So if you have that knowledge, you probably want to start down that MVP road and start to understand, use the MVP as your basis for understanding your market. If you don't have that, then you absolutely start with customer interviews, right? You need to not only understand the problem, but you also need to understand the incentive structures. You need to understand who's your user, who's your buyer. It's the common thing is, this industry is still run on paper. Okay, it's 2022. We've had 40 years of desktop computing. We've had 20 years of SaaS. There's probably some other reasons not related to technology that is causing that to happen in that industry. And you need to go, as somebody that doesn't understand the industry, you need to go and find out why. Why are you still using using paper and pencil? Because the answer isn't going to be nobody's built software for this, right? The answer is going to be far more about the incentive structures, the friction of deploying software, all of the other things around it, not just the actual software itself.
So it sounds like when you're working with companies and what you've gained through your own experience is that you've created, and you said you've made lots of mistakes along the way. So you've kind of almost created a template of where you're seeing a faster way to get from A to B versus here's the standard, what everybody does. They go in, 95% of founders are builders. They just want to build, and they forget to sell. So then when they go out to sell, they wonder why they don't make it. And it's because they haven't actually learned what the market is. And they built the Lamborghini when they should have been building the Fiat or something. So there's a really disconnect between what that entrepreneur knows and what they're trying to achieve. And does that go, and you mentioned experience, but does that go back down to, well, then you should only invest in entrepreneurs that have 2 to 3 year companies that have done it a couple of times versus someone who's just built their first one because they're going to go through all the mistakes that you really don't want to go through. And it's going to be a long cycle. So just focus on founders that have done it before.
Well, I mean, I think that's part of our job as investors, right? And as operator investors. So myself and my 2 partners, we've all been entrepreneurs for 20 plus years. We've all scaled companies. We've all had exits, and that's part of our job, right? And that's the relationship we want to develop with our founders. Is we can't do the work for our founders. That's just it. It's not how things work, but we can help you learn from our mistakes. We can help you learn from our experience, and this is what's kind of interesting about sort of even on the venture side, is not only our experience from 15 years ago running Easy Seed or starting Easy Seed, but also from working with our other portfolio founders, right? Of, hey, these other three founders are having a very similar problem, and this is the way that we've been able to solve it successfully with them. So I don't think it precludes the first-time founder, because I think there's other pieces that as a repeat founder, you start to get you may get a little bit jaded, or you may start to fall prey to this worked in my last company, therefore it will work in this company. Which isn't always the case, right? There's a lot of decisions that you make as a CEO that are very predicated on the current team you have, the time in the market you're going after. Like there's what worked for you then may not work. What worked for you then may not work for you today, just because of different sort of different extraneous factors.
So the experience is obviously key, but it's breaking through the experience and not holding yourself to the bad things that you learn, but just using those learnings to kind of shape the next thing going forward. So being open-minded, I guess, across the entire time that you're doing this, and not looking at your past mistakes and trying to run away and avoid them, but more trying to accept them and figure out how can I build on this and be stronger or better for the next company.
Absolutely. And I usually refer to that as, I call that synthesis, right? Of where you're going to take, as a founder, if you're taking my advice, I don't ever want you to, if I say I think you should do X, I don't ever want you to go and just immediately do X, right? Like that's not really the intention. The idea really is for you to synthesize your own experience, my experience, advice, input from advisors, input from other investors, and synthesize that to the current moment that you exist in your company and in kind of the overall market cycle. That's what any founder needs to do. That's what I need to do as an investor. I need to synthesize all of the different information that I consume, even when it comes to, pattern matching. I've been in the ticketing space. I'm not a fan necessarily of companies that are in that market for a lot of reasons, but I constantly have to sort of challenge my assumptions, because there will be change, there will be evolution. If you had asked people 25 years ago whether or not consumers would use digital ticketing, they would have told you absolutely not, right? And now ticketing is 100% digital. So you always have to understand the unique timing in the moment. So even if you are an experienced founder, you need to be taking all of these signals and interpreting how they apply, if they apply, and what you do with that information in your company.
So is there a timeline that you look at, or working with your founders, that you're always iterating on this strategy and this plan? So if you have a company you've made an investment in and they're going forward and they've got this 5-year vision, you look at companies like Toyota, most Japanese manufacturing companies, they've got 20-year models. So they already know where they're going to be in 20 years. They're shaping the market to get them there. So maybe that doesn't work so well in a startup space, but if you look at the startup, are you asking them to always be looking at that plan, reiterate if you have to every month, but make sure your whole team is aligned to that plan, even if you have to make small pivots inside of that plan? Are you always trying to iterate on that?
Yeah, we always look at it from the perspective of we want to see sort of an annual plan revisited quarterly, and that's what I did when I was a CEO. And even it dovetails into the bigger vision, right? So the way I'll describe it is usually the next 6 to 9 months. That's usually high certainty, right? Almost 100% probability. Next 6 to 9 months, you know what's going to happen. The 12 to 24 month period out beyond this, it's a 50-50, right? You have enough information now to understand what should likely happen over the course of the next 12 to 24 months. Beyond 24 months is useful from understanding your potential direction, but realistically speaking, that's going to change a lot, right? A lot of things can change over the course of a 24-month period. So, but you don't want to lose that big vision of where you're going to go next, because really you need to have what you're doing in that near-term period, the midterm period, and that long-term. They all tie together to actually grow and scale, especially if you're trying to build a venture capable company.
So does this now fall on to what you talked about, which was learning what it takes to be a CEO versus an operator?
It absolutely does. As an operator, you're really only looking at that. You're looking at that near-term window. You fail to see, as you look out to those further time periods, right? When you look out to those 3-year time periods, that's where you start hiring people that are better at that job than you, right? Like that's when you look at it and go, well, if we're going to get to that future point, I need to hire somebody. Yeah, I can go log on to AdWords and create PPC campaigns, but that's not, A, it's not efficient use of my time, but B, I'm never going to be as good at that as somebody that specializes in. And oh, by the way, AdWords isn't the only component of our of our sort of marketing strategy that's going to lead to getting us to where we're going to need to be. So you really start having to look at the big picture rather than the micro. And as an operator, you are just going to focus on that micro. You're going to focus on that next 6 months.
While getting enough data in from that micro side to be able to make those decisions. So taking your experience that you've had through the companies that you've built, do you find that you could have been, knowing what you know today, you've been more effective learning better how to operate as a CEO versus just operating as a startup founder? Is there a significant difference there that you can share to the audience? Focus on these 3 things. They'll help you better understand your market, your business, and how you drive your business forward. Because there's going to be another stage that, when you get to Series A, where you're going to have to try to tear that apart and start looking at a different way of looking at a macro of your business. Can you share some of those details?
I mean, I think the lens is always sort of the same, and it goes back to something that you said a little bit earlier, is focus on selling it, focus on the market. And that's really what's going to drive your success as a business, and also your success in venture capital. You don't run into too many cases of where a company is generating too much money to talk to VCs, right? If you're generating that's never an objection to an investment of, oh, you're generating too much sales, I can't invest in you. It may mean your valuation too high, but at the end of the day, like sort of sales and understanding where the market is going to go is one of those incredibly important pivot points to deal with, especially early on. And it's very, very difficult for especially a technical founder to let go of their baby, to basically say, my vision is X, but the market wants Y. I'm going to deliver Y. And as a technical founder and as a product-oriented founder, you really, really like X. Like that's your idea, that's your baby. And if the market is saying, well, I don't really want that. Like that's not what I want. That's not what I need. You have to be able to let go of that and quickly shift to that. And I've worked with founders as an advisor and as an investor over the years that have walked into meetings with large customers, global brands, and said, well, no, I hear how you're doing it, but you're doing it wrong. You need to do it our way to use our product, right? That's not how you operate. So really that focus on sell it first, give the market what it wants. It's not to be said that you can't create markets, but you have a much higher probability of success if you give the market what it wants.
And then you're going to kind of keep iterating. And I've seen that you also spend a lot of time advising, coaching inside of businesses. So it sounds like you're kind of taking this 30 years of learning of wins, fails, etc., and learning again how to be a CEO. Is that kind of your mandate, is trying to push that back into the ecosystem so that founders can better strap themselves with valuable, not just metrics, but valuable insights on how to actually run a company? Because I think from what I'm hearing and what I've learned as well along the way is that a lot of founders early on are running and gunning, and maybe they haven't matured enough in understanding how to get out of an operational role and get into the big macro view of where this company has to go. And it could be financial, could be many reasons. But it sounds like a founder right from the get-go should be looking to speak with, or on a regular basis, at least interact with somebody that has that advisory coaching experience that can help guide them out of that operational role.
Oh, absolutely. And if you can find a mentor that can help you think big picture, right? And that's one of the big differences that you can sort of point out between an operator and a CEO, is that level of strategic thinking. And I know it sounds cliche, but it's really having that big picture view and understanding the big picture vantage point, understanding where you're going to go, understanding that, as I delegate this, as I delegate this particular task, yes, it's going to take me time to delegate it, but it's also going to free me up time for things that only I can do as the CEO or founder of this company. But it absolutely, advisory boards, if they're run well, and there's two things that I would suggest to any founder looking to find advisors is, one, make sure you have a rapport personally with the individual, that it's not just, oh my God, Jeff is really, really smart. He's worked with a lot of startups, works with a lot of investors. I need to have him be an advisor, but the two of you don't have any kind of common ground. You don't relate to one another. Conversations are strained. Like that's no good in an advisory relationship. The second is, you need to have advisors that don't insist on being the smartest people in the room. You need to have advisors that understand that concept that I was talking about before, that their expectation of you isn't adherence, it's that synthesis, right? So that somebody that, yeah, I've been there and done that, whether it's building product, whether it's marketing, whether it's sales, I've done it, but it's also been a while. And it's also been in a different company, in a different market, with different customers, with a different team. I don't expect you to necessarily do it exactly the way I do it. And that's what you should want from your advisors, to say, hey, here's all the different things I've seen and I've done, right? And you pick, founder and CEO, you pick how you think you should approach it. Which of those tactics, which of those approaches, how do you apply it to your own business? And a lot of times that's incredibly frustrating for advisors, because they're used to being the smartest person at sales. Like, they built a massive sales organization. So, it's not easy to say, well, hey, yet what you did at Oracle 2 years ago, that doesn't work for a 5-person startup. Like, how do we scale that down? Those are sort of the two pieces, right? You have to have that rapport, and they have to be geared to mentor, not sort of rule, I guess.
No, that's super valuable. And I think rapport obviously allows for the two to share information, and then ensuring that the CEO is still the CEO. Your goal is to coach them into these next layers. So if you're in there trying to overpower and dictate how something's being done, then that's not really assisting them in growth and allowing them to start understanding big picture. So that mentorship really has to work like a mentor, and supporting them and propping them forward with ideas or introductions to other people that can help them grow as well along their journey. I think a lot of the time it's like a teacher, I guess. Your teacher is to help your students get to the next grade. It's not to figure out how to keep everybody in the same grade. Then nothing's going to move forward. And I guess sometimes it gets tough, because what you did 20 years ago, you may feel that experience is really warranted today, even though they didn't have TikTok back then. It's the same thing as using Skype. And you're like, no, they really aren't the same. So the markets are changing and they are different, and you have to adapt to those times. So I think it's really valuable that you're coaching, but you're not coaching from a top, you're coaching from an equal, and helping, propping them up and giving them the value. So now, taking what you said earlier and sharing that there is a big difference between, on your role, angel versus VC, how did you see that change happening when you went from being an operator, being a CEO of a company, switching into now supporting through an angel network and being able to support founders? How did you find that transition went? And then you kind of took the whole leap right into VC. And I think there is always a misunderstanding what VC actually means versus what an angel is. And maybe you can share a little bit about those differences too.
It went poorly because I didn't personally understand that second piece, right? That it really is about, I'm going to give you context and it's up to you to make decisions as CEO, right? Which is hard. You come from 20 years of being in the driver's seat. It's hard to now kind of move to the passenger seat and simply try to be the GPS to where they may take the route you give them, but they may also go a different route. So that went relatively poorly. I think one of the bigger differences between VC and angel is really the size of the seat that we have at the table. One of the things I didn't realize becoming an angel is how transactional it is. As much as a lot of the conversation in the ether is, hey, you'll become an angel investor, you'll get to work with your portfolio companies. You get to work with your portfolio companies, you get to advise them, you'll work together, all that kind of fun stuff. really doesn't happen because there's so much work involved in fundraising for a company, especially from angels. There is no time to develop a relationship, right? They take my check and move on to the next investor. They take their check and move on to the next investor. And that's not a criticism of the founders. That's just kind of the nature of the way the process works in angel investing. And oh, by the way, I have other things that are my day job. I have other responsibilities, roles. As you make the shift to being an actual VC, well, one, we're writing a much bigger check. So hopefully you're not talking to 800 VCs like you would with angel investors. But two is part of my job and part of why I was basically hired, for lack of a better term, by my investors, is to provide stewardship and guidance to our portfolio. And that means that's my day job. Like that is what I'm supposed to be there to do. So there's a vastly different structure of how I interact with my portfolio companies because A, it's part of sort of the mandate of our investment is that we will meet on a monthly basis. But B is my full-time job all day, every day is to find new companies and support our existing companies. So it's my job, it's my job to, if you need to contact a company here in Dallas, it's part of my job to see if I can do everything I can through my network, my partners' networks, our investors, however I possibly can to find that contact at that company to help you. And that's a vast difference between an angel investor that's doing this sort of as a hobby. Like it's not your job. Like it's not your job to, if I've got a contact that I can make an introduction to, I'll make an introduction. But the level of commitment is going to be very, very different if it's sort of a hobby or it's something you do in your spare time than it is as a vocation.
And then you found that when you made that transition from founder to angel investor to now into the venture capital side of things, now you're almost stepping up a completely new level. So you went from operator CEO to angel, tactical, hands-on, helping when you didn't think you needed to help, and you're jumping in a lot to now the next layer, which is on the venture capital side. Now you're paying attention to other people's money, making that investment, and still having to do some of that operational side, but pulling yourself away enough where it's more tactical and it's more bigger vision, which is, hey, I can get you in front of this group, or I can move you into this area and help you facilitate that next move. Is that kind of the stages that you've gone through? And you really keep getting more of an umbrella view of this entire ecosystem as each stage you move on from.
You really do have to keep sort of zooming out, right? And it's no different than your progression as an entrepreneur, is that you keep zooming out. Like, day one, you're writing code. Year 10, you don't even know what the code's written in anymore, right? Like, just, I think Python, maybe, right? But that's kind of the progression that you go through, even as an investor, is, you go from this sort of intimate involvement, you go from being, it's a different sort of portfolio construction, but understanding, you go from every investment I'm going to live or die with, right? Because this is, it's my money, it's coming out of my checkbook. And I mean, I'm invested in my fund, so I'm partly investing my own money. But as a VC, you take that much broader view, is that it is about the portfolio, it is about generating those returns for investors. And I know it may sound a little callous, but I'm not going to live and die with every investment the same way I do as an angel investor, because the entire structure of VC is about that power law and it's about that portfolio. So you're going to look at the big picture, right? You need to look at how are all of my companies doing, not just, hey, how is this one or how are these two doing? It really is about that entire portfolio, which again, it's very much, it helps to actually push you to that macro strategic view, because you're thinking about your portfolio broadly, not individual companies.
No, I love that. That's awesome. And it really does give you this focus that I have to work as a whole versus individually. And if you don't shift to that, you'll spend so much time in the weeds, which is, again, the problem of being an operator versus being a CEO. It becomes the same thing, an angel versus a VC. If you're stuck in the weeds, you'll start to lose more companies and lose more value because you haven't been strategic and coming in with that broader view.
And the beauty is you also get an economy of scale, right? So ultimately what happens is, if if you have that broad-based portfolio view, as we develop relationships with other investors, maybe they're only a fintech investor. Well, I don't need to try to convince you to talk to, a deep tech investment or a platform play, right? Like, I can develop that relationship with you knowing that at a certain point, I'll have an investment that you might be interested in partnering with us on because, we have a similar thesis, or, if I develop that connection with a Fortune 500 company here in Dallas, right? If I develop that relationship on both sides can benefit from the broader portfolio, not just, hey, look at this one thing from my one company. It's, we become a potential partner for a lot of different ways and a lot of different resources. So you do get that economy of scale as you move from being an angel to a VC.
I love it. There's one story that pops into my mind to an earlier point that you were making about that shift. And I remember standing in the elevator with Calvin McDonald, who's now the CEO of Lululemon, or has been for the last couple of years. And he was my boss, and we came out of a meeting and stepped in the elevator, and he looked at me, and I guess I looked like deer in headlights. And he said, did that meeting go the way you wanted it to? And I kind of had that, not really, because in my head, I was trying to process, how can I change this? And his comment was, now let's figure out how to shift it so that it gets to where you need it to be. And it's interesting that is that, again, that bigger scale view is that you went in, you were tactful, it may not have worked. Now let's figure out how to make that bigger vision view work. So what do you need to make that happen? And I think in any entrepreneur, as they grow that, scale that business and start to interest VCs, a lot of the things that you shared are really getting them into that bigger picture so that they can execute and start to drive out, say, larger investments or bigger revenues, whatever that might be. So I think all of what you shared is obviously amazing and very valuable.
Awesome.
The next thing I want to dive into, because we got to talk some tech, maybe you can share a little bit about a few of the questions I had, and I think that you could really kind of, I guess, blow these ones up. But I think a lot of companies tend to be focused today on building AI, staying that they're AI, and being that you like to invest in AI. How many of the companies are you seeing are actually AI-based companies versus matching algorithms that they feel that they are building AI, but they haven't actually got to AI at this point? Is there a number, and are there ways that you can get the founders to shift their mindset from, instead of using the buzzwords and being more tactful in this area? Is there something you can share that say, hey, this is a way you need to go in order to get in towards being more of an AI complicit business versus stating that you are and finding out later that you're not, or whatever that might look like?
Absolutely. So generally speaking, about a third of the companies that we see that we pass on, that we actually take a close look at, don't actually fit our definition of AI. And our definition of AI is pretty broad. We include machine learning. We include some companies that have a long-term AI strategy that, hey, we need to go collect data. We need to go collect data for the next 18 months. Then once we get that data, then we can go do these other really cool things. And I think that's really the crux of what we look for as AI investors, right? Is, do you understand the tech, and do you understand where artificial intelligence can create value in your product? And that is the key distinction that we look for as investors, and we look for from founders and from CTOs, is, where does it create value in your product? Because at the end of the day, your customer doesn't care that it's AI. Like, truthfully, they don't care. What they care about is that it's 95% accurate it's 95% accurate, or the company that I know here in Dallas is 99.9% accurate in transcribing an invoice, right? That the customer doesn't care that you're using AI to do it. What they care about is that invoice has been transcribed properly. That's what they care about. That's what they really focus on. So what we look for is founders that know how to articulate the way the technology drives ROI in their product. Where we tune out pretty quickly is, hey, here's where we're going to bolt on chat. Here's where we're going to bolt on sentiment analysis. Here's where we're going to go and take some off-the-shelf product and bolt it onto our product. That's, in reality, the AI, the value being generated by artificial intelligence is really from that third-party product you bolted on. It's not from your product. So I know it's a bit broad, but That's kind of really the distinction is, understanding what is it good at, which also means you don't need to actually understand the tech, right? You need to understand the 4 or 5 things that AI is good at and understand how those impact your product. You don't need to understand how to train a model. You don't need to know how to train a deep neural net. Like, you don't need to know how to do those things. You just need to know, what do I need to give to the neural net, and what do I get out of a neural net, and how does that affect my product?
And which is great. So does that also entail that when you're putting this together, you're looking heavily at that early team as well, and you're defining all the roles and saying, okay, you guys don't actually have anybody that is a Python developer. How are you actually really working in this AI stream? So are you really diving in as well to pinpoint out, to make sure that all of these equal out to the output that you're looking for?
So, I think to a certain extent, it's still such a nascent field. It reminds me a lot of the web in '95 when I got started in tech, right? Is you didn't have web developers, right? You were taking mainframe developers, you were taking client server developers, you were taking traditional developers and handing them HTML and going, hey, go build a web app, right? We're doing the same thing right now, and we're at the same level of maturity in the technology. With the technology and with with sort of the training in AI. So we're taking, JavaScript developers, we're taking, SQL developers, and we're turning them into data scientists. So the exact skill sets on the team are less of a concern than actually understanding that big picture vision. Because we're investing so early that a lot of our companies, like, if you press me on it, it's like, yeah, they're not really, they can't do AI. They really can't build highly accurate models right now, just because they don't have enough data, or they don't understand enough of the features in it. So, we understand that there's an evolution, and even generally speaking, whether it's AI or any kind of software product, at the seed stage, your product is bubblegum and duct tape. Like, it is not like what it's going to look like 3 years from now. Like, the term technical debt is going to be one that gets thrown around 3 years from now, and it doesn't matter what you do early on. So,
no, fair enough. And it's good that you share that, because as much as we want everybody to be perfect and to build that 18-month system, it's not going to happen. As you mentioned earlier, it's going to be that smaller version, and that smaller version might be a few band-aids here and there that are kind of holding it together and popsicle sticks. But at the end of the day, maybe that is what is needed to prove the market. And then it's the next stage and the next shot of brilliance that's going to move them into the bigger picture, and that's going to help it.
Absolutely. And I had a company that I launched and shut down a couple of years ago that was a recommender system in the ticketing space. And before we ever trained any models, there was one key assumption we needed to try, and we needed to figure out, will consumers respond to a curated result, right? Will they respond to the recommendations? That's question number one. I don't need to build any AI to do that. And first is, will a consumer respond to curation? Then you start to get into, okay, what degree of curation is necessary, because it may not even need to be curated and personalized one-to-one. It may just simply be, let me curate it based on some high-level factors, and now I've got a result without ever implementing it. So in a lot of cases, you're going to go through that discovery process without having to go build the tech. Going back to a lot of our conversation earlier, is like, how do you get to that point? And how do you get to that MVP without investing too much time and energy? And training models doesn't, strangely, training your models and being accurate with your models, in many cases, doesn't prove that it actually solves the problem.
Interesting. Very interesting. Now, taking that perspective and what you've built and all these great things you've done, blockchain, tokenizing, NFTs, and AI, tie all these things together, Web 3.0, where do you see the industry moving to? Are all of these going to be big, massive industries in the next 3 to 5 years, 10 years? Are they like what you said, as they're the web in 95, and these are all going to be the best next things coming? Or do you see there going to be a shift? And do you think AI kind of dominates over this? Or is it a blockchain shift that gets up? What do you think is going to be the way that these markets are going to play?
So I look at AI is in the trough of disillusionment right now. We're starting to come out of it to where we're starting to see broader based acceptance, like that standard Gartner hype cycle, to where, about 2015, 2016, AI really peaked when everybody had a chatbot for everything, and every single chatbot was terrible. And we basically turned the entire market off to artificial intelligence. Now we're starting to see it come out, but again, it's coming back. AI is having sort of a resurgence because we're talking about the problem it solves. We're not talking about its AI, it's AI driven. It's really just, here's the problem that we solve. I think we just broke the peak on blockchain. And we're heading into the trough of disillusionment. I think a lot of the sort of over exuberance, a lot of some of those early use cases have turned people off. But I think they're coming from the ticketing space. I can tell you that for smart contracts and open ecosystems, there's lots of opportunity with ticketing, right? And it's just going to take, there's a different, in blockchain, there's a different dynamic because it requires collaboration in places where lack of collaboration creates a competitive advantage, right? So Ticketmaster has a competitive advantage because they don't collaborate. It's a closed ecosystem. Therefore, they own the vast majority of the data. They have control over the market. As soon as that opens up, and right, as soon as a ticket becomes a thing that exists on a block on a chain, now Ticketmaster loses that control. Now control gets handed back to the consumer, gets handed to the team, it gets handed to, it gets taken away from Ticketmaster. And that's one of the things that we need to solve in the process of adopting blockchain is how do you deal with those incentive structures?
No, well shared. And it makes me think of the music industry. TikTok becomes the decentralized part to how music is now being distributed everywhere. So you're losing the big players in music because of a TikTok, because of social media. So in the same instance with ticketing, Ticketmaster is that same thing. But if you drop that into a blockchain or drop that out that anybody can now equally go in and get tickets, and you create that company that now does this, whatever that company is, you've now done the same thing you did to the music industry, where you've dropped everything down to the common denominator where you can't go anywhere else. And that goes for all tickets. So there is a way to decentralize that. And I think you can almost look at this as that every industry is going into that decentralized component where everybody's been running big on the bank side. And now you talk in the last interview that we did, there was all of the banks in Latin America. Well, they're all doing a bad job, or they have been recently doing a bad job. Well, now you can decentralize them all and create many, many, many players that all fill in the gaps along the bottom, which again forced that change like the music industry or like the ticket industry.
Yeah, and that's really where the opportunity is, right? And that's the barrier to adoption. The barrier to me in decentralization does tend to be around the incumbent players fighting to hold on to their information advantage, right? Or their competitive advantage that's delivered by closed ecosystems rather than delivering value.
Well, it sounds like it's going to be one big whopping change in the next 10 years. You're going to see a lot of these big players start to drop, I guess, because they're not going to be able to keep that control that they wish. Now, banking maybe in North America might be a little tougher because they've done a great job at managing it and controlling it. So maybe that's not as easily broken, but it seems like a lot of other players are going to be faced with these incumbents coming in and changing their markets.
Absolutely.
Brilliant. All right, we're going to make a shift. We're going to go into being a little bit more tactful now. We're going to talk to, if you can share maybe a case study, if you will, of an experience or a startup that you've worked with in your past that really kind of define what it takes to be an entrepreneur. I think we all have these glorious moments where we think entrepreneurship is billion-dollar unicorns every day and every night. But there are a lot of things that have to go into them. And maybe you can share a quick anecdotal story or something that you know of that really kind of blew that out of the water for you.
So this is one that's relatively recent, and it's one that goes back to a lot of our talk about how you work with advisors and synthesis of information, and how you actually how you adapt as an executive. So one of our portfolio companies had an opportunity, called me up and said, "Hey, we really want to take advantage of this opportunity." And my first response was, oh my God, no. Run far, run fast, don't do it. And instead of leaving it at that, right, instead of letting me just talk him out of it, he looked at me and he said, well, what are your objections to it? Right. And I said, well, here's the three or four objections that I have, and he said, well, if we can come up with a way to solve those, would you be in favor of us pursuing this opportunity? And I said, sure. Well, give me a week, schedule a call for next week, and we'll go from there. So he goes away. We schedule the call for next week. He comes back, sends me over kind of his like 10-point plan of how he's going to pursue this opportunity. And I look at that plan, and I'll be honest, it actually made me feel jealous as an operator. Like, I looked at it and I said, wow, like he actually took my input and actually created a plan better than I think I could have created. Right. And, I looked at the results, and I'm like, if you can make this work, this is a massive win. Right. And I love that story as an entrepreneur not willing to take no for an answer, but doing it in a way that isn't just pig-headed stubborn of, no, I'm going to do it anyway, but of listening to his trusted advisors, listening to the market and saying, hey, we need to make, there's something broken about the way we're pursuing this. Let's figure out a better way to do this and creating a better outcome. So that's probably one of my favorite stories about as of late, and it ties into a lot of what we talked to.
I love it. Not taking no for an answer, but coming up and being strategic about it. I think that's brilliant, and it like I said, it puts you in a spot where you actually, maybe the word wouldn't be jealous. Maybe the word is excited for the fact that somebody was able to build something outside of your purview that you didn't think was possible in the space, and they proved you that they could. And that goes to your coaching and advising. So that's a good thing. It makes you feel good because you're like, hey man, we helped you in a way get this far, and now you've really stepped it up a notch. You're really a CEO. And I think that's pretty phenomenal. So that's an incredible story. I love it. All right, we're going to move into rapid fire questions. Okay. So pick one or the other as an investor perspective. Okay. Founder or unicorn? Founder or co-founder?
Founder.
Unicorn or a 4-year 10x exit?
I'm a VC now. Unicorn.
Love it. Tech or CPG?
Oh, tech.
NFT or Web 3.0?
Web 3.0.
AI or blockchain?
I got to say AI. My LP's a king.
First time founder or second, third time founder?
Second or third time founder.
First money in or Series A?
First money in.
Angel or VC?
VC.
Board seat or observer?
Observer.
Safe or convertible note?
Convertible.
Lead or follow?
Either, but follow.
Equity or interest?
Equity.
Favorite part of investing?
Being on the bleeding edge.
I love that part too. Number of companies invested per year?
6 to 8.
Love it. Any preferred terms?
We typically cap out around a 15 million post. So we're usually looking at companies, we're looking at rounds between 750 and 3 million, up to about a 15 million post money.
Perfect. 2 qualities a startup needs in order to stand out to you.
Well, it's really their product. Their product needs to be a need. Their product needs to be a need, and their team really needs to understand the problem that they're solving, whether they have experience in it or not.
Okay. We're going to shift to the personal side. Sure. Book or movie?
Movie.
Superman or Batman?
Batman.
Restaurant or picnic?
Restaurant.
5 minutes with Bezos or Oprah?
Bezos.
Mountain or beach?
Mountain.
Bike or run?
Bike.
Big Mac or Chicken McNuggets?
Nuggets.
Trophy or money?
Money.
Beer or wine?
Beer.
Camera or mobile phone?
Camera.
King or rich?
Rich.
Concert or amusement park?
Amusement park.
Fortune cookie or birthday cake?
Birthday cake.
TED Talk or book reading?
TED Talk.
TikTok or Instagram?
TikTok.
Facebook or LinkedIn?
LinkedIn.
Most famous person that pops in your mind?
Probably because I have an office full of it. Walter Payton.
Nice. Favorite movie and what character would you play?
Favorite movie is Matrix. So it'd have to be Neo, right?
Yeah, that's perfect. Favorite book?
I'm supposed to say something venture related, but all that's coming to mind right now is The Three Musketeers by Alexander Dumas.
Haven't read that one, I don't think, but it sounds like it's good. Doesn't have to be venture related. We learn from everything we read.
Mm-hmm.
First brand that pops into your mind?
Apple. You're priming with the AirPods.
Favorite sports team?
Chicago Bears.
The Bears. What is the meaning of success to you?
The meaning of success is not having any have-tos, right? Like if you're successful, you don't have to get up today. You don't have to go to that meeting. You don't have to do anything, right? That's success to me, not having have-tos.
That's it. I like that one. It's good. I don't want any have-tos either. Yep. What is your superpower?
I'm a really strong read of people, even if I haven't met them.
I like it. I like data. So in the case of asking these questions, it's profiling, I guess, but you learn a lot from it, and it's fascinating. But I can say that Apple, and maybe it's the AirPods, but Apple is like a 60% choice of investors. And
well, I've been looking at the AirPods for the last 45 minutes. So like you are doing a little bit of priming, although I've also been looking at the Dell logo on my laptop too. So
they do a great job. Apple is phenomenal on how they do market. So regardless of just there's a lot of signals, but they do a great job. And for not being the number one mobile carrier, et cetera, they've done a pretty phenomenal job. So. But we learn everywhere we go. So big fan of that. But I think, David, I want to say that it's been a pleasure. I've taken lots of notes. It's been awesome to be able to get the time to spend with you and to dive into not only your background, but what you guys are up to today and how you guys see the space of AI and all of the areas that kind of support it and where it's going. But again, I appreciate all the insights. It's been awesome. And the way we like to kind of end our show is we like to give you the last comments and thoughts and share that to the startup community and to investors alike. So I turn it over to you, but thank you again for sharing today. It's been a privilege getting to chat with you.
Well, thank you. It's been the same. This has been a ton of fun. Honestly, the thing that I would share with founders is, DMs are open, email is open. We love to talk to founders, and our goal as founders is I just said this today, is that every founder we work with should be referenceable, whether we invest them or not. Like, you may not like me very much because I pass on your company and you're not a fit for our thesis, but hopefully everyone that I encounter, we've treated with respect, we've treated you fairly. And that you'd be willing to say those things about, and we treated you with honesty, right? That's kind of our goal and how we want to work with the world, and hope to get the chance to work with you more and work with some of your listeners.
I love it. And last question: how do people get a hold of you? What's is there email, LinkedIn? What's the best way?
DMs are open on Twitter. Reach out on LinkedIn, and also it's just david@sentiro.vc. Happy to talk to anyone. We don't require warm intros.
I love it. Well, again, I appreciate all your time, David. Thank you very much for sharing.
Awesome. Thank you, Jeff.
Well, there's been a lot of great discussion with David, and certainly a lot of things that we dived into, from your MVP to, even if you're going to start off, instead of building the big system, there was always that retraction and going and building something small, getting out to market, testing the market, learning from them. There's lots of companies that are changing from paper to digital, and hopefully they're all at that stage now. But the synthesis was really the one that really stood out for me on his advisory side and how to make and build the CEO. So not just be an operator and running a company, but being the CEO of a company. I think that's really impactful today, as startup founders start to grow their business and start to get out of the day-to-day and start moving into that micro. I think he shared a lot of great information and insights on how you kind of move from, building out this strong rapport with your team, and learning and being the best in that industry, taking insights from advisors, coaches, everybody, and then synthesizing that back into your strategy, into your plan, and then being able to keep moving yourself forward and growing and allowing your team to take over and become the drivers of areas of your business as you grow as a founder and grow into that CEO role and start being more macro. So a lot of great insights, very exciting conversation. And I will have to say it was always great to talk with a fellow techie. So thank you everyone for joining us today. If you enjoyed this conversation, please feel free to share with your friends or subscribe to our YouTube channel. Follow us on Spotify, Apple Podcasts, and or Stitcher. Feel free to share an audio or video clip around our show with any questions that we may be able to include in the next future podcast. Find us at marketing@opn.com. openpeoplenetwork.com. Your support and comments are truly appreciated. You can also check us out at supportersfund.com or startup events. Visit openpeoplenetwork.com. Thank you and have a fantastic day.